Every morning, petrochemical procurement managers face potential million-dollar margin swings. Their decisions rely on a constant stream of fragmented daily intelligence feeds. We can see how this data functions by examining a report from Polymer Bazaar. This is an alert sent on August 12th. It arrives as a dense smartphone notification, filled with emojis, shorthand, and figures. At first glance, the information appears disorganized. The feed contains mixed units, various plus and minus indicators, and a wide array of regional abbreviations. To an industry professional, however, this text follows a specific internal logic that maps out manufacturing costs across the globe. Extracting value from this alert requires evaluating the data through three lenses: the chemical hierarchy, regional geographic spreads, and specific supply chain liabilities. This process allows a trader to track global feedstock margins as they shift in real time. In commodities trading, the standard for professional analysis begins with converting this daily stream into a structured model. We begin with the very first line of the text: naphtha. Naphtha is the primary liquid feedstock. It is the upstream bedrock that dictates the cost of petrochemical production throughout Asia and Europe. This $50 upward indicator represents a sudden cost pressure at the absolute source of the chemical chain. We must also identify the logistical delivery term listed here, C&F, or cost and freight. Under C&F terms, the seller pays for marine transport to Japan, but the buyer assumes marine insurance risk once cargo is in transit. A $50 naphtha spike on a C&F basis compresses the margins for every downstream Asian manufacturer relying on that feedstock. Moving down the chemical hierarchy to the foundational olefins, we can extract the propylene and ethylene data for the USA and Europe. The United States data is quoted in cents per pound with a delivery term of FDGC, meaning free delivered to the Gulf Coast. For both of these monomers in the US market, the price trend is declining. This shows the US market is isolated from global naphtha volatility. American producers rely on domestic ethane cracking, providing a structural cost advantage. The European data shifts the measurement into euros per metric ton. The European propylene market shows a specific price spread: CIF Northwest Europe at 935 and FD Northwest Europe at 1035. CIF indicates delivery is covered only to the regional port. FD requires the seller to manage the final inland transport to the buyer's facility. The €100 difference between these two quotes is the mathematical premium required for final inland logistics. Analyzing these molecules globally requires a simultaneous translation of currencies, metric weight conversions, and the logistical premiums between the port and the factory gate. We can now map the Asian propylene and ethylene data alongside downstream intermediates like styrene, PTA, and MEG. In this region, the feed uses US dollars per metric ton as the standard metric. There are two distinct supply chain targets listed: CFR China and FOB Korea. FOB, or free on board, means the buyer assumes all liability and freight costs the moment the chemical is loaded in Korea. Shifting down the value chain allows us to see how the initial $50 naphtha spike is absorbed by these complex derivatives. The styrene and PTA data both show slight upward trends of $10. This increase shows that these intermediate markets have the pricing power to pass along a portion of the upstream naphtha volatility. We can compare this to the MEG data, which is marked NC for no change. MEG's flat price, despite rising raw material costs, indicates a weak derivative market, where producers must absorb the upstream increases themselves. This daily feed identifies which sectors possess the pricing power to withstand raw material spikes, and which are forced to accept lower margins. When we reconstruct these fragments, we get a unified view of the August 12th global market. The result is a clear snapshot: rising upstream naphtha, stable olefins in Europe and Asia, and declining prices in the isolated US market. Producing this summary manually each day requires calculating spreads, translating units, and decoding delivery terms for every single entry. Performing these calculations manually every morning is a significant time investment in high-frequency trading environments. This is the context for the bottom of the feed, which offers an AI-powered WhatsApp chatbot. The complexity of the data we've just navigated explains why automated tools are being integrated into this sector. Automating the ingestion of these feeds handles the repetitive unit conversions and spread calculations that are required to identify profit margins across the entire value chain. While raw data is ubiquitous, a commercial advantage is found in the speed at which these daily updates become a functional, structural matrix.